Inflation in the US has ticked higher again in December, keeping the US Federal Reserve cautious about declaring victory in its fight against price increases. Consumer prices rose 3.4% from the same month last year, up from November's 5-month low of 3.1%. That's delivered a fresh blow to the Fed's efforts to slow inflation to its 2% target. But some analysts are still expecting the Fed to start cutting interest rates as soon as March, after pausing its cycle of rate hikes in the second half of 2023. Inflation has cooled rapidly through most of 2023, after hitting a 4-decade high of 9.1% in June 2022, when the war in Ukraine sent energy prices surging. On a month-to-month basis, the consumer price index climbed 0.3% in December, up from 0.1% growth seen in the previous month. Much of the increase came due to a 0.5% increase in shelter costs, which was responsible for more than half the headline increase. Motor vehicle insurance surged 1.5% higher, marking a 20.3% increase from the same month last year. And while the world's largest economy continues its battle against inflation, its banking sector struggles with volatile interest rates and rising loan losses. JP Morgan, Bank of America, Citigroup and Wells Fargo have reported falling earnings in the fourth quarter of 2023 as they set aside more reserve to cover potential loan defaults. Earnings were also dented by higher bond yields that resulted in unrealized losses. But yields started falling through the end of 2023 on hopes of rate cuts ahead, with the US 10-year Treasury yields retreating sharply from a peak of 5% to below 4%. For more on this now, Nour Hammoury is joining us from Kansas City, Missouri. He's the Chief Market Strategy at SquaredFinancial. Thank you very much for being with us today. Right, so inflation was higher than expected. Why, first of all? And what do you think will happen next? Will it keep coming off, but more slowly than we had initially anticipated?
Yeah, I mean, inflation, the general inflation was up, yes, and this was basically half of that inflation was driven by the price of rents. But what matters the most for the Federal Reserve is what's so-called the core CPI, or basically the consumer price index, which excluding the food and energy prices, which continued to slow down to new levels not seen since 2021. That's a good sign for the Federal Reserve. Yes, the data were mixed, but this basically confirms that the core inflation, which is the most important thing for the Federal Reserve right now, is that the core inflation continues to slow down. I think, I mean, even despite the fact that the general inflation picked up, I think this is another just a short-term play, a short-term move before inflation to slow down even further. And not to forget also, what matters the most for the Federal Reserve in the next few weeks is basically what is called the core PCE price index, which continues also to slow down, just like the core inflation. And we will be waiting for the data in the next 2 weeks. And this is the index that the Federal Reserve consider as the most accurate inflation gauge, which is expected also to keep on slowing down. So I think the month of December's inflation data, don't forget also, this is the holiday season. This is also normal to see some sort of uptick in inflation, but I don't think so. This is gonna last for long.
Really, really interesting, and we will keep a close eye on what happens on the PCE index front. You're right, but in the meantime, on the Fed monetary policy front, what do you think will change at this point? Because we know that in the last meeting, surprisingly somewhat, they really opened the door to rate cuts. What do you think is going to happen at this point, and what does the market expect?
Yeah, after the inflation data yesterday, but we saw the what's called the Fed Fund futures dip down when it comes to the March meeting, or the next March meeting. Estimates were, or the market's basically pricing in 70% chance of a 25 basis point rate cut in March. After the data, this basically probability went down to 60%, but at the end of the day, it went back down. It went back up, sorry, to 73%. Today, also, we had the PPI data, or the Producers Price Index, which also continued to show another wave of slowing down. Now the core PPI is down to 1.8%, below the 2% that is supposed to be the Federal inflation target. This gives us also what basically this means that the Federal Reserve policy is not going to change anytime soon. But at the same time, we know for the fact that the Federal Reserve will even not just bring the idea of rate cuts this year, but I think at some point the Federal Reserve will have to cut more than we expect. General consensus in the market that the first rate cut will be in March by 25 basis points, but at some point, I think this year, the Federal Reserve will be forced to cut more than 25 basis points each in each meeting, which means it's going to be probably, I would say, at least 50 basis points that might be actually happening or might be needed by June of this year.
Are you concerned at all with what's happening now in the Red Sea and the Houthis' attacks and the response by the US and the UK in the first place? Because some analysts were worrying this week that this would, mean a tick up again in inflation, global inflation, problems with shippings worldwide. Do you agree?
Here's what could be concerning. Does this whatever's happening in the Red Sea right now, or with Yemen and the US and the UK, does this actually disrupt the supply chain from Asia to Europe? Yes, but we still have other routes. We still have, it's not just only the Red Sea through Suez Canal and then all the way to Europe. What the Houthis said very clearly that they will be attacking, or they will be basically targeting any shipment going to Israel, not any shipments going to Europe, which is a good thing, at least when it comes to the inflation. When it comes to the inflation story, yes, we might see an uptick in inflation because of the delay of the deliveries, but this would not change the idea that, again, inflation is still slowing down gradually. We need it to continue to slow down gradually. In fact, for consumers, we would like to see, instead of inflation, I would like to see deflation going forward. But this might not be realistic, at least for this at this point. But yes, the risk of a higher inflation or a tick in inflation higher in the next few months, it is highly possible, yes. But this would be, again, because of the delay of deliveries, not because that there's a disruption in manufacturing when it comes at least from Asia to Europe. So this concern would be, I think it would be a short-term play. It wouldn't be like a long-term play that as if it's going to affect the long term.